Guys, the Dow just hit 7 days in a row of up market. Now, this is not the Dow behind me. This is the S&P for the heat map. One thing that's interesting, NVIDIA was actually down 1.85% today. Kind of surprised about that. Semiconductors in general were down today, but Apple was up 1%. So it's some good news there. Microsoft, part of the Dow, was up 0.43%. Now, before we go any further, I want to explain why I hate the Dow. I think the Dow is the dumbest index in the world, and here's why. It has nothing to do with market cap. What I mean by that is this. This is the S&P 500. The larger the market cap of the business, the larger share it is, the more it drives the value, which makes sense. If a market cap of the S&P, hypothetically, was $10 trillion, it's way more than that. Let's say it was 10 trillion, and one company was 1 trillion of that. As that company moved up and down, it would account for 10% of the up and down movement because it's 10% of the index. For the Dow, it doesn't work that way. Here's how it works for the Dow, which is extremely, extremely asinine. The Dow cares about one thing and one thing only. The Dow cares about the actual stock price. Now, most investors out there buy into this because they think a $30 stock is more expensive than a $15 stock. That makes zero sense. Here's why. Let me give you 2 examples here. Let's look at Berkshire Hathaway Class A shares. $615,000. Clearly the most expensive, I put that in quotes, stock on the stock market. It's the highest share price. But look at the market cap. Let's scroll down a little bit. Market cap is $886 billion. Microsoft, a couple trillion, 3 trillion. Apple, 2 trillion. Amazon are way higher than this. All they did different was they have more shares outstanding. Don't be the sucker who thinks that a high share price means a company is more expensive. When I was in high school, I was a sophomore. I was investing in money. I was fortunate enough to understand this. A kid in my class asked the Algebra 2 trig teacher if he wished he had Nike stock. And the guy said, "Oh, I wish I could, but it's just so expensive." I remember thinking to myself, like, what does he know about it being expensive? I remember back then thinking to myself, that was the part of me that knew there was something like value investing, but I didn't understand what it was. Now, don't get me wrong. I got sucked in .coms and tech and all that stuff and lost money doing that. But eventually that Paul came out here. And I realized that had nothing to do with the share price. It has to do with what those shares are buying. But not the Dow. The Dow does not care. The Dow, let's pick 2 companies from the Dow. Here's a great example to show you guys. Look at these 2 companies. Cisco on the Dow and Disney on the Dow. Both of them have a $194 billion market cap. So according to the S&P, they would account for the exact same percentage of the S&P. But look at this. Current price on Cisco, $47. Current price on Disney, $105. That means that Disney accounts for over 2 times the price movement than Cisco, even though they're the exact same size. Do not fall for the sucker's bet that the Dow, now granted, the only reason we talk about the Dow is everybody assumes that's the market. I do not think that's the market. The S&P 500 is the market. That's the market. The Dow is the rookie market. And I apologize if this offends you. And if I haven't offended you and you like seeing a channel that does 4 or 5 reaction videos a week that can also teach you, subscribe to this channel. I'm here to teach a process. This is not an opinion. This is complete objective truth here. The fact of the matter is Cisco and Disney are the exact same market cap, and yet Disney's price movements account for over 2 times more than Cisco's based on the Dow. Let's go to another extreme. Nike is double the price of Cisco. Yet Nike market cap is $140 billion to Cisco's $194 billion. Come on. It's ridiculous here. So the Dow's on its 7th winning streak. The S&P is doing well. The Nasdaq's doing well. Does that mean we're out of the wood? I don't know. We have no idea what's going to happen in the markets. I love when I hear banks adjust their targets for the end of the year. First off, they don't base it on any fundamentals. Any person worth their weight in gold will tell you there's no use in trying to guess what's going to happen in the short run. Is this really important to understand for investing? Yes and no. It's more about having you think and understand that there are differences in what people talk about. Investing is hard because you hear people talk about the Dow and that inside you says, well, if everybody talks about it, it must mean that it's a good thing. It's like, well, maybe, but I want you to be able to ask questions, asking questions and getting answers. I want you to be that Paul from sophomore year of high school who wanted to sit there and raise his hand and say, what do you mean it's too expensive? I know what he meant. He meant I can't buy a lot of shares because the price is too high. That's not expensive. That's not expensive at all. Price versus value. Expensive means price is well above value. That is not your goal as an investor. Your goal is to buy when value is significantly above price. How do you determine value? Many ways. Applying a multiple to earnings, the future. Every investment is the present value of all future cash flow. No matter if the company is growing 20% a year or 3% a year. Every investment is the present value of all future cash flow. No matter how fast that cash flow is growing, you can take it and decide what you're willing to pay today for that. You absolutely should pay a premium to faster growing, better businesses. But there is a price to pay that's too high. When we talk about the S&P, in our community here of like-minded investors, I always put in our stock market to GDP ratio. What that ratio does is it tells you, because Warren Buffett says at any given time, it's the most reliable metric of where valuations stand. And right now, we're almost double historical valuations. And I know there's going to be people out there that say, well, it doesn't matter anymore. Fine. Then what about the 10-year cyclically adjusted PE ratio? What that does is it takes all the 10 years of earnings and brings it to today with using inflation. And guess what? That's also double historical average. So any way you cut it, we're still at high valuations. And I see the complacency in the market. I see people talking about this. Listen, this doesn't mean you don't buy stocks. Don't make the mistake I made. I thought the valuations were too high. They would fall back quickly. They did not. They got even worse. And in that time, the fundamentals got better. So even if I bought great companies at decent, over a little bit more expensive than I wanted to, I would have still made more money and bought them at prices lower than what they're worth today. And that's what's key. We're here to teach a great process of buying great companies at good prices and dollar cost averaging into low cost ETFs. But that's easy to do when stocks are rising high. We've only had one bear market. I don't even consider COVID a bear market, as crazy as that sounds. It was 1 month of catastrophe and then right back up to new highs. We had 2022, that felt ugly, but it rebounded. So we're telling people, especially people who've never experienced a bear market, a real one, that we've had 2 big falls in the last 5 years, in the last 15 years, and guess what? They rebounded very quickly. That's not the way it should go. We can't have cryptocurrencies and all these high-flying tech companies selling for nosebleed valuations because of a great story. If that makes sense to you guys, join our community of like-minded investors. $7 for 7 days, comes with all the tools of our software, but more importantly, the community that you can have these conversations with, because investing can be a lonely road. And when it's a lonely road, you're going to make bad emotional decisions. In order to make more money, you need to keep your emotions in control. Peter Lynch says, everybody has the brain power to invest in stocks. Not everybody has the stomach to invest in stocks. That's what I'm trying to teach you. So click the link below, $7 for 7 days. There's only a limited number of spots every day. So make sure you sign up when you see a spot available. And if you have to join the wait list, do it, because you will get an email to fast track yourself. But guys, don't look at the short run of the market. Yes, we have a 7-day winning streak. We came off a few weeks of bad way. It's just, this is the way markets go. And we have no idea where they're going to go in the short run. But we do know in the long run, 10, 20, 30 years, you're probably going to make money. In fact, I don't think there's been a 20-year period of time going back to 1870 in which you did not make money over a rolling 20-year period. But in any given year, it's about a 55% chance of making money versus 45. But you look in the last 15 years, it's basically been a 1 billion% chance you make money. And that's just not right. That's not the way markets should be. It shouldn't be easy to make money. It shouldn't reward just foolish, throw money, throw darts at the wall and see what happens, and you always win. That should not happen. Do I think the next 10 years are going to be great? I do not. Does that mean you can't make money? Of course you can, because guess what? Your goal should be this. The market's value goes like this, but the stock market goes like this. If you dollar cost average up and down, you'll end up paying this, because sometimes you'll overpay, sometimes you'll underpay, but you'll end up paying the average. And that's the goal here. You have plenty of time to make those decisions. Don't sit there and try to guess what's going to happen in the market. Don't listen to short-term news. Don't feel FOMO because the Dow has 7 days in a row. I'm here to teach you, and the community is here to teach you that the short run does not matter. In the short run, stocks are a voting machine. In the long run, they're a weighing machine.